The US economy has already been hit hard by the viral outbreak. GDP was the worst ever on record in Q2, falling 32.9%. Job growth slowed in September after hitting a peak in June. 661,000 jobs were added last month, down from 1.489 million in August.
There's a lot of underlying economic problems. There's problems with income inequality. There's problems with the national debt. There's all sorts of problems, but you're not going to fix any of that until you address COVID and you put in place a plan that fixes that. It hasn't been done yet, which is why the economy is suffering much worse than it needs to.
To help the economy along, the US Congress had passed a first stimulus package in March, which provided a $600 unemployment benefit to each of the 25 million eligible Americans. US lawmakers were supposed to agree on a second stimulus bill after the first one expired at the end of July.
It has become an election issue. Both sides are very far apart in terms of what they are agreeing to in terms of amount. Democrats have proposed a $2.2 trillion of stimulus. On the other hand, Republicans have offered $1.6 trillion.
Differences between Republicans and Democrats on the particular response has been such that for one of the first times in a very long history, the two sides are not coming together immediately and providing additional support. You know, we've had 36 times in the past during economic crises where emergency unemployment insurance has been extended. Essentially, each and every time it was necessary, it could get done.
Many experts say more stimulus is needed, as both economic and employment data remain weak.
It has certainly caused some permanent damage to the economy. US economy will take a lot of time to go back to where it was before the crisis. For example, the unemployment rate is still very high. So go back to full employment level of below 4%, it's going to take few years. So meanwhile, the marginal part of the society, they will suffer. Similar case for industries as well. Some of the industries like shared economy or tourism, which were really doing very well before the crisis, they will suffer under the COVID crisis, and it will take a lot of time for them to recover.
However, there remain bright spots. Despite all the hits it's taken, observers agree that the United States is a pretty resilient economy.
When I think about how we've responded to that with digitization, the ability to work remotely is going to provide some lasting flexibility to workers. We'll find out that it can make us more productive. And again, that doesn't necessarily lead to more jobs immediately, but it does lead to more economic capacity.
Citi also thinks the beaten down sectors will stage a slow recovery through 2021.
Many of the things that have grown very rapidly this year won't see the benefits again. I certainly think that travel, tourism, shopping in person, these sorts of things will see a very substantial rebound. And it's likely, we think, in the coming year, with so many vaccines and late-stage clinical trials, it seems quite apparent that the US and the world economy will have a phase of coming out of COVID, which will be fairly dramatic as well, just as it was going in. And we should not expect this effect immediately. It's more likely to unfold over the course of 2021. Our best estimate is that we will attain that in early 2022. The economy will exceed its late 2019 peak in absolute level.
As the woes on Main Street played out, Wall Street logged its worst monthly performance in September since the sell-off in March.
There are multiple risks. The first risk is the election risk. There's still a lot of uncertainty with the outcome, contested election, and that could lead to a lot of volatility in the market. The second risk is that economic momentum is going to slow down, especially as it looks like we are not going to see the next round of fiscal stimulus bill in US. And the third risk is that we still have virus out there.
In this volatile market environment, what is an investor to do with their equities?
Within equities, we would suggest to stick with the markets which have strong fundamentals. And that's where Asia comes into the picture. Most of the North Asian markets like China, Taiwan, they are doing very well because virus has been contained. economies are recovering, and earnings have been very strong.
And for bonds, Mr. Tantia has this advice for investors.
In bonds, you can be more aggressive because central banks are providing direct support there, and rates are going to remain lower for longer. So within bonds, high-grade bonds, investment-grade bonds, they look very interesting. They still offer 3% yield in US dollar.
He adds that gold is a must-have in any portfolio.
Investors would like to hold liquidity in light of the election risk and other risk. I think it's better to hold that liquidity in gold. Instead of holding cash in US dollar or any other currencies, investors used to see gold as a metal. But right now, it works as a diversification, as a currency.
For Citi's Mr. Wheating, COVID-19 has led to a fundamental change in the composition of the US stock market.
It's divided up financial markets into what we call COVID cyclicals and COVID defensives. And those defensives have included technology, media, telecom, and healthcare shares. You combine this dramatic monetary policy easing fiscal policy, tax policy, and support for families, with the fact that the US stock market has had the largest share of these defensive companies. That has meant this year turned out much better than many investors expected.
Mr. Wheating says that the longer-term investment opportunities lie outside the United States.
We think that the opportunity will move to those markets that have been more beaten down and have lagged the United States without the preponderance of technology companies in the indices. And that, again, will be the story for 2021. Because whole regions of the world, Latin America, and some other parts of emerging markets, are completely beaten down by COVID. And the history of their crises often leads to very sharp rebounds. They could just circle back to where they were before, and that could provide a very strong opportunity.